Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United Parcel Service Inc. Annual Report. United Parcel Service, UPS, offers a wide range of transportation and delivery services to individuals and businesses worldwide. The company operates through two main segments, U.S. Domestic Package and International Package. The U.S. Domestic Package segment provides time-definite delivery services for express letters, documents, packages, and palletized freight through air and ground services. This includes guaranteed day and time-definite international transportation services, as well as contract-only solutions for non-urgent shipments. In addition to domestic services, UPS also offers a range of international services, including small package operations in various regions such as Europe, the Middle East, Africa, Canada, Latin America, and Asia. The company provides cross-border ground package delivery, day-definite services, and international air and ocean freight forwarding. UPS's services extend beyond transportation to include contract logistics, customs brokerage and insurance, mail services, healthcare logistics, distribution, and post-sale services. This comprehensive range of offerings makes UPS a one-stop shop for businesses and individuals seeking reliable and efficient logistics solutions. The stock price of United Parcel Service Inc. UPS has remained relatively stable over the past year, with no significant changes exceeding 4.17%. The most notable event was the fourth quarter 2025 earnings report and strategic announcements in January 2026. Despite beating analyst estimates and revealing plans to cut operational roles and close package sortation centers, UPS shares only jumped 3.8%, falling short of the threshold. The lack of significant stock price fluctuations can be attributed to several factors. The quarterly earnings reports for Q1, Q2, and Q3 2025 did not provide detailed immediate reactions that would have allowed for a definitive assessment against the 4.17% threshold. This suggests that these events also likely fell below the defined significant change threshold. The stability in UPS stock price can be seen as a reflection of the company's consistent financial performance and strategic plans, which have been well received by investors. However, it is essential to note that the absence of significant changes does not necessarily indicate a lack of growth or opportunities for the company. The United Parcel Service, Inc. market capitalization of $98 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that United Parcel Service, Inc. holds a significant advantage in their industry. United Parcel Service, Inc. trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 6.03 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 5.69%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline at UPS are multifaceted and influenced by a range of internal and external factors. One key driver is customer incentives and guaranteed service refunds, which can impact revenue growth or decline. Meeting certain targets through the achievement of incentive tiers or performance metrics also contributes to increased revenue. Changes in rates charged to customers, addition of distinct services, payment terms, and collectability of accounts receivable are other significant drivers that affect revenue growth or decline. Segment-specific drivers, such as time-definite delivery services for U.S. domestic package and guaranteed day, and time-definite international transportation services for international package, also play a crucial role. External factors like foreign currency exchange contracts, investment income, expense, and other fuel surcharges and foreign currency cash flow hedging program can either positively or negatively impact revenue growth or decline. Additionally, transformation strategy costs and asset impairment charges can have a significant effect on revenue, particularly in specific years, such as 2025. Overall, the primary drivers of revenue growth or decline at UPS are influenced by a complex interplay of internal and external factors that require careful management to achieve optimal results. The net income of the company experienced a decline from 2024 to 2025. The decrease was significant, ranging from $182 million to $419 million across different reports. This drop can be attributed to various factors, including asset impairment charges and changes in general economic conditions. Profit margins also saw a decline during this period. Operating margin decreased by 230 basis points to 15.5% in 2025, while non-GAAP adjusted operating margin dropped from 18.7% in 2023 to 15.8% in 2025. However, there was an increase in non-GAAP adjusted operating margin from 7.5% in 2024 to 7.7% in 2025. The reasons behind these changes are multifaceted and include significant competition, loss of customers, failure to attract or retain employees, cybersecurity incidents, and economic uncertainties. The company's inability to effectively integrate acquired businesses and changing fuel and energy prices also contributed to the decline in net income and profit margins. The company's financial performance indicates a consistent generation of positive operating cash flow. According to the provided data, both in 2024 and 2025, the net cash from operating activities was significantly high, with figures of $10,122 million and $8,450 million respectively. This trend suggests that the company is efficiently managing its operations, resulting in a substantial inflow of cash. The company's financial health has undergone significant changes in the past year. A notable trend is the increase in debt level, which has risen from $21,284 million in 2024 to $24,127 million in 2025. This represents a substantial growth of approximately $2,843 million. Furthermore, the interest expenses have also seen a considerable surge. The company's interest expense increased by 17.4% from 2024, indicating a significant rise in borrowing costs. Additionally, the average interest rates for bonds have increased, contributing to the higher debt level and interest expenses. These changes suggest that the company is facing increasing financial burdens, which may impact its future performance and profitability. The performance of various segments and regions in the industry has been mixed, with some areas showing significant growth while others struggled. On a positive note, the U.S. domestic network saw strong results, as did Europe's domestic market, which experienced a 1.4% increase in average daily volume. Canada also performed well, with a similar 1.4% increase in domestic average daily volume. In addition to these regional successes, there were notable gains in export volumes between European countries, with an impressive 3.5% increase. This growth was driven by the strong performance of small and medium-sized businesses, SMBs, in Europe. However, not all regions fared as well. The international package business and SCS business both underperformed, while China to U.S. trade lane volumes declined due to changes in U.S. trade policies. Furthermore, Asia's export revenue per piece fell by 0.6%, and EMEA's export revenue per piece also declined by the same margin. These results highlight areas where improvement is needed to drive overall growth and success in the industry. The management of the company is outlining a comprehensive strategy to transform its operations and adapt to changing market conditions. A key aspect of this plan is the implementation of a transformation strategy that includes workforce reductions, process changes, and technological advancements. This effort aims to create a more efficient operating model through automation and operational sort consolidation. The company is also right-sizing its business in response to macroeconomic headwinds and volume declines. This involves enhancing responsiveness to market dynamics and investing in strategic acquisitions to increase complex cold chain logistics capabilities internationally. These moves are expected to have a positive impact on future performance. Management is focused on improving efficiency and reducing costs through workforce reductions, automation, and operational sort consolidation. The company's pension and post-retirement benefit obligations are being managed with actuarial assumptions that reflect the process for settling these obligations. Overall, the management strategy is centered around creating a more agile and responsive business that can thrive in a rapidly changing market. The company has made significant moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its portfolio with two notable deals. Firstly, Frigotrans was acquired in January 2025, marking a strategic move that is mentioned across multiple pages in the extracted summaries. Secondly, AHG was acquired in November 2025, further solidifying the company's position. On the other hand, the company has also divested certain assets to streamline its operations and focus on core business areas. One notable example of this is the sale of Coyote, a truckload brokerage business, in 2024. This move is highlighted across multiple pages in the summaries, indicating its significance in the company's strategic planning. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. Evidence of this can be seen on page 20, where it is stated that the company has declared and paid quarterly basis dividends, indicating a consistent payment schedule. Furthermore, page 115 explicitly confirms that the company has indeed paid dividends. In addition to paying dividends, the company has also been actively buying back its shares. On page 20, it is noted that in 2025, the company repurchased 8.6 million shares of Class B common stock for a total of $1 billion. This is corroborated by page 44, which provides further details on the share buybacks, stating that in 2025, the company spent $1 billion to purchase 8.6 million shares. Overall, these actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and strategic share repurchases. Concerns about supply chain disruption and efficiency. The extracted summaries reveal several concerns regarding supply chain disruption and efficiency. One of the primary concerns is the impact of disruptions on significant customers' businesses, including strikes, work stoppages, or slowdowns by employees, cybersecurity incidents, and physical security breaches, page 10. Additionally, changes in general economic conditions may also affect the company's operations, page 9. The decline in China to U.S. trade lane volume due to U.S. trade policy changes is another significant concern, page 34. Furthermore, increased pickup and delivery expenses, mainly due to increased volumes, are also affecting the company's operations, page 24. The integration of air and ground networks has become more expensive due to unfavorable currency movements, aircraft maintenance expenses, and higher charter utilization associated with network disruptions and capacity constraints, page 34. The forwarding revenue decreased by 38.3%, while operating expenses increased, indicating potential issues with supply chain efficiency, page 35. Demand softness in air and ocean markets, effects of changing trade policies, and tariff uncertainty are also affecting the company's operations, page 36. The reconfiguration of the U.S. network and consolidation of facilities and workforce may also impact supply chain management, page 67. Overall, these concerns highlight potential issues with supply chain disruption and efficiency, which may have a significant impact on the company's operations and profitability. That concludes the financial summary for United Parcel Service Inc. Feel free to comment below, and I will be happy to answer them when possible.